Okay, good morning to everybody. So we're starting at today is Monday in week 11, and I want to, as I always try to do, start out with where we had sort of ended up in the previous section. We're talking about chapter 14, which deals with incremental analysis and everything that goes along with it. And so we're right here, and notice that the exam is due this week. It should be available right now. Actually, it should have popped up automatically at Brightspace, and it's going to be due on Sunday the 10th. Notice too that I obviously this is the original syllabus, so it's not adjusted for some of the due date changes that I made. But I moved the due date for the chapter 14 activities, that is homework, quiz, bonus, to the 10th. So you've got this week to kind of do that, and this exam is going to cover chapters 13, Appendix F, and chapter 14, and it'll be available until Sunday. So my plan for today is I've got just a little bit to talk about with regard to chapter 14, just to sort of finish up that piece of the puzzle. And I do want to spend some time before we leave to do some problems and exercises from the back of the chapter, just to sort of give you a bit of a highlight or preview as to what you might expect to see, particularly on the homework and also the quiz. So we'll do that. Okay. So that's the plan for this week. And the exam is available. Well, what I'm going to do is, if I don't get through the problems and exercises that I expected to get through, I'll certainly cover it on Wednesday, and I'll do a review section for the exam, and I'll talk about what to expect on the exam, some of the things you should focus on, and what's the format and structure and all that. So we'll do that on Wednesday, and that'll give you Wednesday, Thursday, Friday, Saturday, Sunday to complete the exam, and I'll talk much more about the parameters, although the parameters are sort of listed for you in Brightspace. There's nothing really that's too secret about that. Okay. All right. So before we get going, any questions about anything? Those of you in the room or those on the Zoom call? Okay. Well, let's pick up we have like one final bit of business to talk about here, and I want to kind of go back a little bit. And remember, incremental analysis is this idea that and I've said before, this is, I think, where accountants really earn their pay, is the idea of being tasked by management to make a decision as to a certain business opportunity. Whether we accept it, whether we don't accept it, sometimes the terms may change, and so it becomes an acceptable proposition as opposed to the original idea, which is not acceptable. And so I think the chapter's done a pretty good job of bringing out those alternative opportunities. That is the idea that, hey, under this scenario, no, we're not going to do it. And I said before that one of the areas that I think is not well understood, I think, by people outside of business, is the idea that sometimes businesses have to say no to opportunities. And it sounds completely bonkers. It sounds like we want all the business we can get. Sometimes it's not profitable enough. We don't want to do it. Okay. So I'm going to go back just a little bit here to where we ended up last time. We're talking about a scenario about repair and replace. Now, remember, if we go back to some of the scenarios that we talked about, I'm going to sort of flip back here just a bit as to what some of the particular opportunities are, and certain scenarios that sort of exist. And I can find it here. And that's the idea of all these different scenarios: special prices, which are basically special orders, whether we make a good or continue to buy it. In other words, do we continue to make it or stop it at a certain point? And that's not always a straightforward proposition. Do we sell the products at a particular point, or do we keep on going? Do we repair, retain, or replace equipment? This really relates to the idea of fixed assets, which are going to wear out. And the idea is, do we repair it and keep it, or do we simply get rid of it and start again? And I think some of the logic of this module revolves around the idea of replacing equipment as being usually the better option, but it's not always, right? Depends on what the cost to replace the equipment is, right? And how long that equipment is expected to be profitable. Eliminate an unprofitable business segment. And also I mentioned buy, lease, buy, build, sell, lease. So these are all sort of alternatives that we are faced with in this sort of one thing or the other. And remember, I sort of presented this as an idea of a binary. That is, if we do one thing, we can't do another. So we're foreclosed from the opportunity of doing something, if we do one thing. So that's really kind of where I want to sort of return to this discussion. We ended up last time talking about this a scenario of repair or replace. So in this case, I know I'm going back a little bit. I get it, but it sort of helps to sometimes review. So Rochester Roofing is facing the decision. The company relies heavily on the use of the 60-foot extension lift for working on large homes. Last year, the company spent $60,000 refurbishing the lift. So immediately one should think, okay, $60,000 spent last year is what kind of a cost? Sunk cost. It's gone. It's done. Regardless of what we do today, those $60,000 that were spent last year are gone. So we can immediately write those off as being irrelevant. And we're interested here in relevant costs, comparing relevant income streams with or revenue streams with relevant cost streams. And it's just determined that another $40,000 repair work is required. So we've got more work to do on top of the $60,000, even though the $60,000 last year is sunk. Alternatively, the company can find a newer used lift that's on sale for $170,000. The company estimates that both the old and new lifts would have a useful lives of 6 years. That kind of makes our work a bit convenient in the sense that the estimated useful life is identical. However, the new lift is more efficient and will reduce operating expenses from $70,000 to $50,000, and the company can also rent the new lift for $2,000 a year. Okay, so we've talked about this before, but what we need to really get into and sort of drill down into is the idea of what is the benefit versus what is the cost. This is a really important idea in managerial accounting. Remember, managerial accounting sort of goes to this idea of how do we make good management decisions based upon accounting data. That's really what is going on here, is the idea of trying to help management make good decisions. And so in this case, the accounting staff is tasked with deciding what should we do. Now, the old lift, if we got rid of it, can be sold for $25,000, which is pretty good, right? And so the new lift, the old lift are estimated to have salvage values of 0. Again, that makes our lives relatively easy. And so prepare an incremental analysis. All right. So this is sort of where we ended up last time, was talking about this idea of if we retain it. And again, over a 6-year period, we have operating expenses, $70,000 per year times 6 is $420, $50,000, which is a reduction in annual operating costs of $300,000. So we immediately have $120,000 boost in net income. If we repair this and keep it, it's $40,000. If we don't keep it and get rid of it, it's nothing, right? If we decide to replace the equipment, we can rent it for $2,000 a year times 6 years, and so as a result, it's an opportunity cost here. Why? Because it's opportunity that we would have foregone to do one thing or another. And we include the new machine cost, which is under this column of replacement. And by doing that, then we can sell the old machine, which is a reduction in overall cost, which gives us $433 versus $460, higher cost to retain it, and therefore we have a higher net income increase. And again, one of the things I do want to talk about, because I know a lot of our students are familiar with time value of money considerations. These are what we call undiscounted values. That is, we're not going out and saying, okay, $1 today is worth more than $1 in 6 years from now, so we're going to discount those dollars. You will do that for those of you who are majors. Really, any business major, I think, is going to probably take finance, and you will discount them based upon the fact that $1 today is worth more than $1 in the future. So these are undiscounted, and there are times in accounting when we do undiscounted figures, and this is one of them. And in this case, it makes more sense to replace the equipment than to retain it. So as a result, we should buy the machine. Okay. So this is what is really being indicated by this. And again, we are really talking here primarily about the quantitative values. And even though we said earlier on that qualitative issues are also important, and sometimes we have to make sure that the decision being made doesn't conflict with other strategic values for whatever reason. In this case, I don't think I can't see what conflict there would be, but sometimes, it really is an issue where do we want to do one thing, given the fact it's going to be some other kind of business problem somewhere else. Okay. All right. So any questions about that? I'm sort of the jumping off point on last Wednesday. And so I want to sort of get into the final bit here, the final learning objective. And that is what I think is really sort of the build up to a lot of what we're doing here. And that's taking the idea analyzing the relevant costs. There's those costs which could change as a result of a decision that may be different than what the present state is, and decide whether or not we keep on doing what we're doing or we eliminate an unprofitable segment or product. This is, by the way, a very modern way of looking at business, because all around us, businesses are getting rid of other lines of business, other subsidiaries, other products that don't make sense. They don't seem to gel with the other products that they're making, and they're spinning these products off, and sometimes in a very successful way. And so this is not unusual at all that businesses will be looking at deciding whether or not we get rid of a product or we keep on going, okay? And again, sometimes it makes sense to get rid of a product, and in doing that, I know it sounds a little bit heartless in the sense that maybe there are employees involved, but that's not always really what's going on here. Sometimes it's a case of where we're doing one thing and we want to sell this particular business to someone else who can do it better, cheaper, and faster. And that's really the heart of what's going on with incremental analysis altogether. So, all right, so let's get into it, and then we'll do some example problems. So in this case, we're going to focus on relevant costs. That is, only those costs which are relevant to the production process. This is not always an easy determination, because I know a lot of times people want to dump into costs, those costs which really are not relevant. Things like, things like office expenses related to the home office. Those are not really relevant. I mean, we assume there's going to be an office, corporate headquarters running things, and those are probably not going to be affected by whatever decision we make out in the field, as we say. We're going to talk about the effect on related product lines that sort of mentioned that a minute ago. And remember, the idea is too that we don't want to cannibalize our existing business if we are a business. And that is, if we want to spin a company, a business off, or a particular product off, is that not going to come back to bite us because somebody else is now running that and competing against us? There's not much you can do about it, I don't think, other than legal agreements to try to prevent that. But then again, legal agreements outside the U.S. don't really have all that much weight. Fixed costs must be absorbed by the other segments. Now, this is going to be a particular scenario that we're going to talk about. I think it's the tennis racket example we get into, where if we decided to divest ourselves of an unprofitable line of business, then the fixed costs, which we have allocated sort of globally across the organization, we've got to reallocate, assuming that we want to continue to maintain those fixed costs. A lot of it's salaries, a lot of it's facilities and things like that, things which we really can't manage in the short run. In the long run, we can deal with it, but in the short run, we got to figure out what to do. Net income may decrease when an unprofitable segment is eliminated. This is one thing that I think disturbs a lot of people, because we have said time and time again in this course, what is the purpose of a business? And remember, in accounting courses, college accounting courses almost always take the point of view of a publicly traded for-profit organization. But if we make a decision that lowers profit, then what on earth are we doing? Well, we may be doing it in the short run, sort of a short-term pain for long-term gain. So this can sometimes be an outcome, and we should sort of be prepared for the idea that maybe divesting ourselves of some line of business may not always be great in the short run. And so the decision rule, by the way, decision rules, which I don't know, I can't recall if your text really gets into this or not, but rules-based decision-making is this idea that we set parameters for what we do, and if the equation makes sense, we do it. If it doesn't make sense, we don't do it. Decision rules are very quantitative in nature. There are a lot of critics of rule-based decision-making, and it goes all the way across the business world. But in this case, if we're going to set a rule, we're going to say, keep the segment unless the fixed costs that we eliminate exceed the contribution margin lost. So remember, let's kind of rewind the tape here. What is contribution margin? It's sales minus variable cost, right? That's contribution margin. And so what is contribution margin, right? So sales minus variable cost equals contribution margin. Contribution to what? It's contribution toward recovering fixed costs and net income. Okay, and that's why the term contribution exists. And by the way, as we get into the final segment of this course, we're going to talk much more about contribution margin as being a way that we measure management's effectiveness, efficiency, because of the idea that they have to contribute, it's the C here, toward net income. Fixed costs are what they are, and we're going to say in the short run, they're mostly fixed. However, the short run, frankly, the business short run is getting shorter and shorter, and so they can be dealt with. Okay. All right. Here's an example. So we have Venus Company manufactures 3 models of tennis rackets. I really like this example. I don't know why, but I do. So they make 3 profitable. So they have profitable lines: the Pro and the Master. These guys here, the net income that we have attributed based upon the costs which we have assigned to them, 80,000 and 50,000 to each of these lines, contributes to net income of 200,000 for the Pro model, 40,000 for the Master model. The Champ model is losing money. Okay. Now, if I were to look at this just as a financial analyst, I would immediately go to this guy right here, right? Variable costs, 90% of revenue. That seems pretty high. It's 70% of revenue here. It's whatever 520 over 800,000 is here. It's less than that. So we've got a really high contribution of variable costs, not so much fixed costs, but variable costs. So in other words, the Champ product is considered to be unprofitable. And the evidence of this is the fact that even if we assign the fixed cost to it, we have $20,000 of net income. That's a drag on net income. So we have $200,000 positive contribution to profit from the Pro line, $40,000 from the Master. That's $240,000, but yet we have a $20,000 drag headwind, right? That brings down total income to $220,000. So as a result, management's thinking, we need to get rid of this particular product. Or do we? Now, this is a question, and it's not one that's got an easy answer sometimes. A lot of it has to do with how we assign fixed costs. A lot of it is how we absorb variable costs. Remember, variable costs include, these are primarily product costs. They're not exactly the same as the income statement variables we looked at for cost of goods sold, where we had direct materials, direct labor, manufacturing overhead, pretty darn close, right? And it's a manufacturer, so most variable costs are going to be product-related costs. So management is thinking here, okay, well, this is not working out so much, so let's think about what to do. So in this case, if we got rid of the Champ line, we have to do what? We have to reallocate the fixed costs. So remember, let me go back here. What are the fixed costs that are associated with the Champ line? 30,000, that's on this third column here. So 30,000 are the allocated fixed costs based on the budgeting process. And so as a result, those $30,000 are going to be reallocated elsewhere. And so if we do it, after we eliminate the line, we're going to say, okay, and this is management discretion. Remember, these are not GAAP prepared financial statements. These are statements that we prepare internally for management to decide what it is they want to do. So we're going to sort of allocate, based upon some sort of rational logic, 2/3 of those reallocated fixed costs to the Pro line and the other third to the Master line. So as a result, we have a higher fixed cost allocated to the Pro line, a higher fixed cost allocated to the Master line. And so as a result, what do we have? We have a net income of $210,000. Well, what we had before? We had $220,000, right? So the question is, do we do this or do we not do it? And I like this in the sense that the numbers are not like overwhelming. It's $10,000. It's not like 50 million or 5 billion or some gigantic number where it would be completely obvious and everyone can agree on it. This is something that is not an easy decision. And by the way, by eliminating that one line, the Champ line, does that make it difficult for us to sell our other products? Sometimes buyers don't like the fact that companies are sort of cutting back on their production. And in these days right now, one of the things we've been hearing a lot about is something called shrinkflation, where some products are made less qualitatively good, I guess is the word. It's probably not very good grammar, but they're kind of cheaping out and higher price and whatnot. And I think we've been seeing this all along. I bought a can of corn the other day that used to be a pretty good sized can of corn. Now it's about half the size. And it's an example for a little bit less price, but it's half the corn as before. Shrinkflation. and customers don't like it, all right? So those are the qualitative decisions that have got to be taken into account. A $10,000 savings, I don't know. I don't know if that makes sense at all. So in this case, the loss is 10,000. That's the loss of income from getting rid of that. So remember, we've sort of presented these scenarios as being either or, A or B kind of decisions, that is binary. If we continue, all the same costs arise for this one particular segment, $20,000 negative contribution to income, which it's understandable why management would want to divest itself. But these fixed costs have got to be reallocated elsewhere. So $20,000 of net income, and we're still going to incur the $30,000 in fixed costs, which leads us to $10,000 being worse off altogether. Now, does that make sense? I don't know. Maybe it does. And there are lots of occasions in business where companies want to stop doing one thing because in the long run it frees up resources to be spent elsewhere. Could be that the facility that makes the champ rackets is old and broken down. It's going to require lots of new investment at some point. So there are a lot of facts we don't know. In this case, all we're simply saying is what? Total income is decreased by 10,000. And so I don't really know that this particular segment tells us what to do. It just tells us what the numbers are and the idea of presenting alternative scenarios. And so in this case, we have reduction in fixed costs. So, but let's do another scenario. Let's say that of those, 22,000 of these fixed costs can be eliminated. What would that be? I suspect labor, probably supervisor salaries. I don't know, but if 22,000 can be saved, then we have a different scenario, don't we? Where what looked like an easy decision, well, okay, we're going to lose 10,000, so maybe we should continue producing the product. Although that's not always clear, and that's part of the ambiguity of this whole picture. What if we eliminate $8,000 or $22,000 of fixed costs? That brings down the total cost, which will reallocate it to the other lines, to only $8,000. So as a result, now what do we have? We have an increase in net income, and now the decision is pretty obvious. The decision is pretty obvious. And I think this is probably a more realistic scenario of what may happen with the reduction of a product line. And companies do this all the time. And by the way, when we say that we're getting rid of a product line, we don't even know here if they're shutting it down or if they're selling it. That's not given in this particular issue here. And so I know it sounds like we're taking a very cavalier approach to laying off workers. And if that's what's going on with the $22,000 savings, and that's not really what necessarily is going on. Sometimes it's an idea of selling the entire product to somebody else. And we've seen this again and again and again. Certain products that used to belong to one company belong to another, and the buyer sometimes has no recognition of that and could really care less, right? Procter & Gamble has sold products. They used to be associated with certain products they've sold to other companies. Customers could really care less. And by the way, the employees probably have moved from one employer to another, okay? All right, so that's what I really want to try to get here is the ambiguity in this whole situation. Here, it makes it a little bit easier of a decision. In the prior case, the company was actually losing money to divest itself of one product that they were very suspicious of in terms of contribution. First of all, a tiny contribution margin associated with it. And we're assuming the fixed cost allocation at the budgeting process was accurate. But it makes sense that you'd want to divest yourself of that. Keep in mind, too, there's a reason why we talked early on in the semester in Chapter 10 about profitability ratios. And that's the idea that companies want to maintain a certain percentage of profitability, return on equity, gross margin percentage, all the contribution margin percentage. All these are metrics by which they're evaluated and, frankly, judged by creditors, by investors, by everybody. And so sometimes keeping your numbers up, which is sort of a mantra in the business world, is an important thing to do. Okay. All right. Any questions about this scenario of the tennis rackets? Okay. If an unprofitable segment is limited, what's the answer? Net income will always increase. Well, yeah, that's a tough one, right? Variable expenses of the limited except will have to be absorbed. No. It's C, fixed expenses will have to be absorbed, and then income will not always decrease. So it's got to be C. So fixed expenses. And think about why this is the case. we eliminate an unprofitable, what we think is unprofitable product or division, or even an entire subsidiary, and the fixed costs which are associated with it have got to be reallocated to the extent that it can be. Now, I like the example that was given with the tennis rackets because we're saying we're getting rid of the one line. We're also getting rid of some of the fixed expenses that go along with it. Salaries, benefits, maybe facilities, maybe lease expense, maybe insurance on certain activities associated with it. Under 22,000 is not a particularly large number. But again, as I've long said, what if we add a bunch of zeros to that? Then it becomes something that we should look at. Okay. All right. One final thing, we'll do some problems, and that is the idea of the unprofitable segment. So Lambert manufactures several types of accessories. For the year, they make knit hats and scarves, and its sales of 400,000, variable costs of 310, and fixed expenses of 120. Well, okay, so you can look right now and see this company's losing money, right? This is just usually income statement happens, right? Sales 400,000, variable expenses 310, fixed expenses of 120. So as a result, we have a net loss going on, right? From this particular line. Now we're going to assume this is maybe one subsidiary or one business they acquired. Who knows? But they're losing money. And rule of thumb in business, you can't lose money forever, unless you've got some sort of angel out there pumping cash into your business. And that's not that unusual because Amazon lost money year after year after year after year, but had all this money being pumped into it and to make it the colossus it is today. But we're not given those set of facts here. We're saying we have a net loss. So if the company eliminates this line of hats and scarves, we're going to save 20,000 or only 20,000 of fixed costs will remain. So we're going to save, in other words, 100,000. So let's look at analysis as to whether or not we should do it or not do it. Okay, so what do we got here? If we keep on going, we continue, and this is a scenario that comes up again and again. If we continue, we're going to have the same net loss as before, year after year after year after year, unless we can grow that somehow. And that's one of those qualitative variables we don't know about. You know, if sales believes they can push this number up, that's one thing. If they can't do it, well, then they can't do it. And by the way, we have this idea that sales go up year after year after year after year. But that's not always the case. Sometimes sales are going down, 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 down. And that's the thing. It's something to be looked at. So the present situation, negative 30,000. If we eliminate all but 20,000, in other words, we eliminate 100,000, that's our savings, we are still going to have a net loss. And so what happens is we still have, we're better off by 10,000. So in this case, we should eliminate this particular business line. All else remaining equal. I go back to that Latin term, ceteris paribus, that says all else remaining equal. What we don't know here is whether or not marketing can sell more hats and scarves. We're not given that information. If they think they get to 500,000 next year, it's going to bring up the variable costs, first of all. Fixed costs will change, if anything, slightly. And that's something we would plug into the spreadsheet to see whether or not that would work or not. And again, Excel spreadsheets are the accountant's best friend. And we'll see what happens if they can do it. And sometimes marketing people feel very confident they can do certain things, and sometimes they can't. They can sell a lot of product that they didn't think they could sell before. So don't take the accountant's word only for this, that we are one piece of the puzzle. There are people out there who can maybe boost sales, and so as a result, that might be the way to go. All right. Okay, so any questions about this particular last bit of segment of the chapter here before we get into doing some other things? I want to sort of pull up the text here, and if you do have questions, feel free to, give me a shout out here. But I do want to go to the text. I'll do some back to the chapter problems. I'm sort of bouncing around here a little bit because I want to sort of pull up the text, not the segments in the chapter, but I want to do a few example problems. So let's do that. So what I want to do, and this is going to be sort of in the last 40 minutes we've got here, I want to do some examples of problems and exercises that we're likely to see on the homework quiz and bonus. Okay, so let's do that. And I'm going to sort of, oops, pull this up here. Let me see. So and just given the reality of what we're doing here with regard to the attend anywheres, I'm going to sort of bring the screen up here in a minute and bring down this particular illustration. But I want to do a few examples here of problems exercises from the back of the chapter. And I want to do the first one here, which is going to be, and it's going to be page 14-27, and it's going to be 14.2, 14.2. And it's basically this. So it's Bogart Company is considering two alternatives. Alternative A will have revenues of $160,000, that is, and cost of $100,000. Alternative B will have revenues of $180,000 and cost of $125,000. Compare alternative A to B, showing incremental costs, revenues, and net income. So I picked this one because it's a pretty straightforward one. And I think it's one that's going to be very easy to sort of figure out. But it's sort of also eases our way into this whole discussion about what we're doing with incremental analysis. And we sort of present this, frankly, sort of simplify this as being option A versus option B. That is a binary thing. We do one thing or the other thing. And I made mention last week that oftentimes we have maybe 3, 4, 5 different scenarios. We got to sort of work through it. But let's not get too caught up in that. Let's just do a brief exercise. 14.2. This is on page 14.27. So we've got two choices. We have A and we have B. Okay. And we're assuming these are mutually exclusive. If we do one thing, we are foreclosed from doing the other thing. And this is a pretty simple example here. All we're really given is we're given revenues or inflows, right? And we're given costs, and revenues minus cost is going to be net income. And so as a result, what do we have here? The math is extraordinarily simple. We have revenues under option A of being 160,000, under option B of being 180. So far, that looks pretty good. So the effect on net income is this, right? From doing one thing or the other. We're going to say that we have an increase in revenue of choosing B. And by the way, A is oftentimes presented as the current case, the base case, and B is the alternative. So in this case, we have an increase in revenue of 20,000. The cost picture goes from 100,000 under option A, the current condition, to 125. Well, that's much higher, right? So in this case, 125 means a $25,000 difference to the bad side, right? And so as a result, all we're doing is simply doing the math here, where we have $60,000 income. And again, we're not including tax here, but that's taxes mostly irrelevant. At 180 minus 125 is 55,000. Well, the difference here is if we choose B, we're going to be worse off by 5,000, which is precisely the difference between 20,000 positive. 25,000 and the revenue which is earned of 20,000. So as a result, we should probably stick with what we're doing. Okay. Not an unusual scenario. I know this is very, very, very simple for us to kind of lay out the facts of what's going on there. Okay. So that's the first one in our example. It's the idea that, okay, we're simply given a set of facts, and this is all we're given is what are the effects on revenue and costs and net income, or revenues or expenses, costs and expenses being interchangeable terms for one another. Okay. All right. So questions about that one? That's a pretty straightforward one. So I want to go to the next one here, and I know that's maybe hard to see on the board. I get it, but if you're on the Zoom link or the video feed of this, it's going to be number 3, brief exercise 14.3. Let me just read it quickly. At Bargain Electronics, it costs $30 per unit, and they've broken that into variable and fixed. The 30 is 20 variable and 10 fixed to make an MP3 player that normally sells for $45. A foreign wholesaler, and again, your text oftentimes sort of emphasizes this idea of a foreign buyer that does not cannibalize the existing products in the existing market because we don't want to sell for less than the market price, but they're outside of this market. So a foreign wholesaler offers to buy 3,000 units at $25 each, not the 45 that we usually get at 25. So Bargain Electronics will incur a special shipping cost of $3 a unit. And assume that Bargain Electronics has excess capacity. And remember, that's one of the conditions for special orders. We can do it if we don't have to add to capacity. Now, I've got a later example here where companies will have to add a little bit of capacity. And that's part of the incremental analysis too. But in this case, there's no extra capacity. We can take the job. Remember, fixed costs are considered generally to be not relevant unless they're fixed overhead, because those are product costs. So here, we're going to incur special shipping of $3 a unit. So that's an additional variable cost. Assume Bargain Electronics is excess capacity, and so indicate the net income that Bargain Electronics would realize by accepting the special order. Okay, so let's do this. So let me get this out of the way here, this textbook. And I'm going to go and erase this. The great thing about videos is we can stop and start, and it's always there. It's going to be there for many, many years in my YouTube channels. So you can get at it. So let's take a look. All we're going to do is sort of lay out the case. Do we do it or do we don't do it? And that's really the issue. We either do a thing or we don't do a thing. And we're going to have to make a decision. And so in this case, this is a brief exercise. 14.3, this is on page 1427. So what are the options? Number one of the options is to do nothing. Just do what we're doing. In other words, we're going to reject the order, okay? By rejecting it, and that sounds like we're making a negative judgment, but we're saying, I guess we are, but we're saying we don't want to do it, right? Thank you for the business idea, and we don't want to do it. And we'll see whether or not that makes sense to do it. Or we can say, okay, we'll do it. And we're not getting into the idea here in this particular course of what if we renegotiate the price and all that? Maybe that's something that is an issue, maybe not. So the effect on net income is the other thing we'll have to look at here in this scenario. All right, so what do we got here? We'll go back to the same sort of methodology where the change in revenues, okay? So if we do nothing, there's not gonna be a change in revenues. This is I put a little delta sign, this is the change in revenues. No, it's not gonna be anything, right? We're not gonna do anything differently. And by the way, the change in costs is not gonna be anything at all because we're not doing anything different. So the little delta symbol, these little triangles represent change in costs. If I can draw it correctly, there's nothing that's going to be any different here. And then the effect on net income, obviously, if neither element is changing here, then nothing is going to change with regard to net income. Sometimes it might make sense to stay in your lane, in your cocoon, and do nothing, but sometimes it does not make sense. What if we do the order? Okay. What are the terms of that order, okay? And it's basically this idea of 3,000 units, and they're not going to pay us our regular price that we sell in the domestic market. They only want to pay us $25 per unit. So, and let's lay out the case. So 3,000 units times 25 is going to be an increase of 75,000 if we do it. And we're going to incur additional shipping costs here. And there are two elements to this. Number one, the variable costs have not changed. And then as it costs us $20 to make the particular product, it's 3,000 times 20 is 6,000, right? But there's also an additional shipping cost of $3 per unit. So as a result, that's another it's 9,000. $3 times the 3,000. $3 times the 3,000 is 9,000. These are both negatives, right? And so we add this up, 75,000 incremental revenue. Addition incremental revenue minus what is 15,000 here is 60,000. 68,000, I'm sorry, is going to give us 6,000 in increase in net income. So as a result, if we go across here and we take the change in net income, what we have a contribution increase of 75,000. Now contribution margin, the contribution to net income, we have $69,000 in this direction. Downward, but we end up at the end of the day $6,000 better off So we're saying that we should accept this order. And why should we accept this order? Well, first of all, we are not including what's a big sort of glaring omission here, and that's fixed costs. Because we're not saying there's any kind of change to fixed costs whatsoever. We haven't even modeled fixed costs here. All we're talking about is the sort of change in costs generally, and primarily what we're talking about is variable costs. And that's really what's going on here. Very often, fixed costs are not part of the picture. And oftentimes, fixed costs don't change unless there's something major organizational that's going on where a company will divest itself of business units or people or whatever. And in this case, that is not what's going on. So in this case, what are we saying? We should accept the order. Okay, even though it doesn't make sense because we're selling it. And if I go back to the original problem here, and this is one of the things that we said early on in this chapter is that there's some counterintuitive stuff going on here, right? And let's begin looking at this real quickly, and that is the idea that it costs us $30 to make a unit, 20 variable, 10 fixed, and yet we're selling it for 25, and we're okay with that. It sounds completely bonkers. Why would we do that? Well, one of the reasons why is because we're making no assumption of a change in fixed cost. The fixed costs in this case are going to be considered fixed in the very short run, so they're not really relevant. And so as a result, if we have excess capacity, which is always part of the conditional part of the conditions here, then we should accept this order because why not? Why not add a little bit of profit? And by the way, there's a reason why earlier on I used the example of Priceline as sort of a particular exemplar of a company that really figured out the idea that companies have excess capacity and can offer more sales to buyers, generate revenue, and maybe not really incur that much in additional product cost, are better off by providing those to people rather than saying, no, we're not going to make it available because that's not our normal price. And again, I know that sellers always want to keep buyers separate from each other. They don't want them communicating as to price and whatnot. But where it exists and where there's a chance to get incremental revenue, which exceeds incremental costs, which is what's going on here. That is, economists will call it marginal revenue, marginal cost. It's the same thing, essentially. If one thing exceeds the other, that is, revenues are greater than costs, we should do it. If it's the other direction, we should not do it. And again, we come back to this idea of all else remaining equal. That is, if there's nothing else that we don't know. Okay. All right. So, any questions about that second brief exercise? I've got one more to do, and it relates. It's similar, and it's not. And I know these first three that I'm doing are not particularly elaborate, and they're not maybe as complex as what you're going to see in the Wiley homework and whatnot. But I'm going to kind of work after that. If I don't get through it today, I certainly will on Wednesday. But I want to do one more brief exercise, and then I want to get a little bit deeper into some of the other ones that have a little bit more involvement, a little bit more tricky situations. And this is going to be brief exercise 14.7, page 14.27. And so it's this one. Brian Company is a factory machine with a book value of $90,000. Okay, automatically I'm thinking, all right, do we really care? That's book value is basically cost minus accumulated depreciation. Remaining useful life for 5 years. It can be sold for $30,000. So there's a residual value that we can sell right now. And this question is about, do we repair or replace, right? The new machine is available at a cost of $400,000, with also 5-year life. That makes our life easy. And the new machine will lower annual costs, variable costs, from $600,000 to $500,000. So prepare an analysis showing whether the old machine should be retained or replaced. Okay, this is another one of those scenarios that we've been talking about, where we're saying, okay, do we do one thing or do we do another? In this case, it relates to a capital asset, that is a piece of machinery, and do we hold on to it? And knowing that it's not very efficient in terms of cost, who knows what that could be? Maybe it requires lots of maintenance, lots of labor hours to maintain it. Maybe it uses, it's maybe not very energy efficient. That's one that we're sort of seeing a lot these days, is the idea of trying to use machinery that's much more efficient with energy to the extent possible. So we've really got two choices here in brief exercise 14.7. And that is, do we retain it or do we replace it? And we're going to say those are the only two options in this case. So retain, which is keep, or do we replace? Okay. And then the effect is going to be the effect on net income, the change in net income. And again, we're using undiscounted cash flows over a 5-year period. All right. So remember, all these variables are going to be bigger than what's given in the problem because we're taking it over 5 years. Okay. So what are the variable manufacturing costs over 5 years? Well, let's go back here. Let's just kind of review what those costs were. I'm going to try to pull this over here so I don't interfere with your screen. So this is 14.7. And we're saying that the annual operating costs are 600,000. 600,000 divided by 5 years is going to be $3 million. Okay. So 3 million, that's 600,000 times 5 years is going to be 300,000, 3 million. And we're not going to be discounting that. So those are the variable costs. Now remember, we'll get into the purchase price here in a second, but this is really all about cost, isn't it? How much we can save, how much we're currently spending, how much it's going to cost us to buy a new piece of machinery, right? If we replace it, we're saying those costs go down by on a 5-year period by 50,000 a year. So those costs go to 2,500,000. So the contribution then to net income is 3 million minus 2 minus 2.5 million is 500,000. So that's to the good. So that's sort of so far so good. Savings and variable costs appear quite interesting. What about the cost of a new machine? Okay. So what is the cost of replacement here? If we don't replace it, the effect here is 0 because we're not changing anything. But here, if we do it, we're going to pay 400,000 for this new machine. So immediately, this is an out-of-pocket expense that brings the scenario down to 400,000. So that's kind of a drag on the not totally wiping out the gains of alternative B, that is the replace, but nonetheless, it makes sense. And here's the thing: what if we sell a machine? What if we sell the old machine? Okay, and in this case, what are we really saying here? If we sell it, we actually reduce our total cost because we get 30,000 in additional income. Now, there are different ways we can do this. I know your text will talk about. We could put it up here as a savings and variable cost. That isn't really where it goes. It doesn't really go in the cost of the machinery, but it reduces the overall cost of this option of buying a new machinery. So as a result, we have a reduction of 30,000 in cost because why? We've chosen to get rid of the old machine and to get the new machine. So as a result, that $30,000 that goes in this direction becomes $30,000 positive in this direction. And does everybody see what we're doing here? We're simply selling one piece of equipment. You could include as an opportunity cost over here if you wanted to. It would have the same effect. It would have the same effect. And this is one area where I think the text could probably be a little bit more consistent in the idea of it's an opportunity cost. If I do this, I don't get the 30,000. If I keep the machine, so it would be an opportunity cost. It would be the same effect though as 30,000 negative 0 here and $30,000. That would suggest the replacement would make sense. And so as a result, let's just sort of add these up here and see what we get. So these are all the columns that are going to tell us what to do. So we have $3 million of variable costs. Remember, we're trying to minimize costs here. And we do the math here, 2,500,000 of variable costs, which we are not going to be able to get rid of given the current level of production, which by the way, it could change over time. We're assuming it's not. 400,000, the cost of the machinery, that's 2,000,009 minus 30,000 is 2,870,000, which is less than 300,000 by $130,000. So as a result, we're better off in this case. And I like the fact that the numbers are a little bit bigger here and there, a little bit more convincing than say $10,000. In this case, we should get rid of the old machine. And by the way, I think a lot of the examples that we see in this module are sort of suggestive of the benefit of replacing machinery with new machinery. It's not always the case that makes sense. It really is not. There are a lot of companies that make do with older equipment, even though they may be less efficient, they may use more fuel, whatever, more maintenance. But in this case, I think it's sort of suggested that we should do one thing or the other. In this case, what should we do? We should replace the equipment and sell it at $30,000. If that's an accurate figure, and that's a residual value that really lowers the cost of output of the new scenario. Okay. All right. So, any questions about that particular problem? Okay, so we've got a little bit of time here, and I really wanted to spend. This is really my objective here. Excuse me. In this particular class session was to talk about some of these inter-chapter exercises, and I want to do a couple more. I've got about 15 minutes, and so I want to sort of scroll down here a little bit and go to some of the exercises. And I'm trying to not do the problems that have got the little blue answers where you can click on, which is good. I think I'm a big fan of that. But I want to do some ones that are a little bit more involved that don't have those answers, and so they can be used as sort of an example. And I would definitely use them as a bit of a template for how you can go on to produce or to work other problems. And so I'm going to have much time to do one more today, but whatever I don't get done today, we have time on Wednesday. And Wednesday, my objective is to sort of finish up and cap off chapter 14 and also talk about the second exam. Okay. All right. So let's talk about 14.2. This is on page 1429. And it says Gruden Company produces golf discs. And I really don't know what a golf disc is. I think it's like a golf with like a little mini frisbees. I think, maybe I'm wrong, which normally sells to retailers for $7 each. Remember, we're selling business to business here. We're a manufacturer. We're making it good. We're selling the product to retailers for $7. It would probably retail for something more clearly. The cost of manufacturing 20,000 discs. Okay, so we're just saying, okay, we're going to say at the $20,000 Q level, quantity level of output, we have materials of 10,000. That's direct materials, direct labor of 30,000, and then the two overhead pieces are divided into two. That's fixed and variable. And we have variable overhead of 20,000, fixed overhead of 40,000. So together we add these up, we get total costs for 20,000. And so obviously, if we make $100,000 divided by 20,000 discs, tells us that it's a $5 per unit production cost. All the costs being absorbed into that. Not period costs, but product costs. And this is one area, again, I go back to what we talked about much earlier in the class. We're only talking about that product costs here. We're not talking about CEO salaries or accountants or legal people or HR. We're talking about, do we do one thing, do we do another, okay? And so these are product-related costs that we're trying to absorb. So what do we got here? Gruden also incurs a 5% sales commission on each disc sold, okay? And we're going to have to determine whether or not that's a relevant cost or not. McGee, which is another company, offers Gruden $44.80, not $5, but lower the cost of production to buy 5,000 discs. Okay, McGee would sell the discs through his own branding in foreign markets, again, to sort of emphasize the fact that these products are not going to interfere or cannibalize the current market. And these are markets not yet served by Gruden, so it's really a question of does Gruden do it or do they not do it? That's one thing. We're not going to get into this idea of negotiation. That's in real life, maybe it would be an issue, but here it's a one or the other. We're going to assume this is the final, offer, right? If Gruden accepts it, it'll incur a one-time fixed cost of $6,000. So this is different than what we've gotten before. It's a one-time cost. Up to this point, all the scenarios that we've gotten into have assumed that there are no additional increases in capacity necessary. Up to this point, we've been saying they've got plenty of capacity. All it is putting workers to work and using the excess space, and the machine time, and the warehousing, and all the stuff that we've got in order to do it. But here we have to incur a fixed cost of $6,000 because we got to rent some machine. Okay, but if we do it, there's no sales commission because our people aren't selling it. It's their people who are selling it. Those are not our costs if we're Gruden. And that's the example that we're going to go with here, okay? All right, so the question is, do we do it or do we not do it? So that's really it, right? With internal analysis. And right now, it's sort of hard to know because we are now exposed to the idea that sometimes what is counterintuitive might make sense. That is, we're selling below our own cost of production, but some of those are fixed costs which are not relevant, and so sometimes we may accept them, but we don't always accept them. So this is why we've got to do the numbers, right? This is why we have to lay it out. This is why accounting staff have templates and modules put together for modeling purposes to allow us to determine, do we do one thing or do we not do a thing, and work out alternative scenarios. And again, as I've said before, this is really where I think the accounting staff can shine. So let's take a look at this. This is exercise 14.2 on page 1429. So what do we got here? First of all, we have two choices. We can either do it or not, right? We can reject the order, right? And say no, or we can accept it. Okay, nothing too difficult here. And then the issue is the change in net income, whether it's positive or negative, as a result of accepting it as opposed to rejecting it. Okay, so those are really the options which we're sort of faced with here is, do we do one thing or do we not do the other thing? And we're assuming these are the final terms. And so let's talk about what are the accounts involved? Well, first of all, if we sell the product, we're going to have revenues, and there's going to be some change in revenues, there's going to be some change in costs. So let's just take it based upon what we know to be a logical construction. We get revenues, right? And we have, this is basically the change in revenues. We've also got the change in direct materials. Remember, which is one of the direct costs, product costs. We have the change in direct labor, right? And then we have the change in variable overhead. Now, one of the things that I think we probably should have gotten into, or I should say your tech should have gotten into, is this idea of overhead as being a product cost, but we can split it into two pieces. And for those of you who are going to be accounting majors and are going to go on to take, I think it's 2240, I don't teach it, it's cost accounting. They get definitely into this idea of dividing and separating costs that are either fixed or variable, and so that's an issue. But overhead costs in general are product costs, so they're relevant. Okay, the fixed overhead cost is not relevant. We're not given that change. We have the cost of equipment rental, which is either we do it or we don't do it, right? And then we have the change in net income. And that is going to then tie back to what we're doing here. So if we don't do anything at all, we say no, nothing changes. 0, 0, 0, 0, 0, all the way down to 0. So that makes our life pretty easy in that regard. And it may make sense for us to say 0. But we don't know until we find out what the value of the alternative is. And so let's look at the alternative. So in this case, we're saying this company now wants to buy 5,000 units, and they're going to pay us $4.80. Below the $5 sales price that we usually, actually, it costs us $5 per unit, right? Back when we first started looking at this. And then they want us to sell it below cost. So let's just see whether that makes sense. So 5,000 units times 480 is going to give us 24,000 in revenue. So that's going to be a contribution to the upside from choosing the plan E here. With materials, and these are positives, obviously. These are inflows, so they are going to push net income up. But what about cost of materials? It's going to cost us 50 cents, right, times the 5,000 units for materials. And so as a result, that's going to be 2,500. Because why? Because we incurred additional amounts of cost to produce these units. The labor piece is going to go up. We're given that of $1.50 per labor per unit. So $1.50 times the 5,000 is going to be 7,500. So that's to the negative as well. Variable overhead, if we do nothing, it's not going to change. But if we do it, it's going to be $1 extra in variable overhead. And we don't know what that is composed of. We're just sort of given it. So $1 times 5,000 is going to be $5,000 negative. So we're going to have a negative contribution to profit here of 5,000. And if we rent the equipment, it's going to cost us 6,000. That's a one-time cost, right? To make this one special order. We're not dealing with the existing capacity. We're going to go out and we have to rent a piece of equipment. That's $6,000. That's a cost of doing business. So that's 6,000 to the negative. So, all right, let's do the math here and see what we end up with. So if we sort of take 24,000, nothing changes here, but 24,000 minus 2,500 minus 75, that's 10,000 together, 15,000, 21,000. That gives us a contribution to income of $3,000. The same goes up here. We get a contribution to income of $3,000. And so as a result, what should we do? Well, it sort of suggests we should take the deal, even though we have to incur additional cost of equipment. Now, one of the things that I think is interesting, and this is where, and maybe I'm getting a little bit off the rails here a bit, but I just kind of want to open the door here to the idea that sometimes companies can choose not to buy something, or just lease it. And a lot of companies go to Home Depot and lease things like big pieces of machinery or other. There are a lot of companies lease equipment. You don't have to buy the equipment necessarily. There are a lot of companies out there that will, like Caterpillar and others that will lease you the equipment to do what you need to do in order to do the special thing. You're not always stuck with the cost of equipment, because here we're suggesting we've bought this thing, it's ours. But what if we can just rent it for a few days or however long it takes? Then it might make sense, okay? So in this case, part B of this is, do we do it or do we not do it? Well, we're saying we should do it. All else remaining equal. All else remaining equal, we should do it, okay? And then the final piece of this was, what are some of the assumptions that we're making? And I think here, some of the assumptions beyond the cost of equipment, which is something that I sort of brought into the mix here, is the idea that the goods they're selling at $4.80, which are less than their own cost of production, are not going to be resold in existing markets where they currently serve, because cannibalizing the market, that is simply cutting your own throat to get market share, doesn't make sense. These are, and again, your text authors sort of went out of their way to make clear these were foreign markets. They're not going to interfere. They're separate markets. In other words, buyers are separate from one another. There's no issue with regard to that. And so as a result, yeah, we should do it. Now, $3,000 is not particularly compelling in a world in which companies do lots and lots and lots of zeros. But what if you had lots of zeros and you're adding zeros to everything in this equation? This would still be zero. This would be more zeros, which is more zeros over here. Maybe it becomes even more compelling. And don't forget the idea that sometimes purchasing equipment doesn't make sense. Sometimes leasing makes sense. And I know that I sort of, students have said over time, you seem to be a fan of leasing, and I am. I think it's a great idea. And first of all, I'm a tax person, and there are tax benefits that we haven't even included here because this is not a tax course, but it's something to keep in mind. Bottom line is that whether we include that particular piece of this or not is mostly irrelevant. All we're trying to do is study the change in what are essentially cash flows. And for those of you who are going to go on to do a bachelor's in business, you will be more exposed to this idea of money in, money out, which is what cash flow really is. And if you can maximize the money in versus the money out, then that is really what we're all about in the business world, okay? All right, any questions about this? Let me sort of, I don't want to neglect my Zoomers here, and I don't see anything in the chat box. Does anybody have any questions for me? Because I think we've got about 4 minutes, but I don't think I have any time to go. The next one's going to be a little bit, I got one more, or two more, I guess, to do, but I don't think I can get into it now. And I've been keeping you guys so late anyway, and I apologize for that. So if there are no questions, I'm going to sort of end this today. And when we come back on Wednesday, I've got a couple more in chapter 14. We'll spend the rest of the class period talking about the exam. And as I've said before, bring your questions. If there are questions, to go back into chapter 13 or whatever, and I'd be more than happy to answer those and try to to help you be as well prepared for the exam as possible, okay? All right, well, enjoy the snow outside, so that's kind of neat that Halloween's over, now it's starting to snow, so, all right, see you next time.